Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. It is Monday, December 15th, 2025. And this week, well, it's setting up to be maybe the most critical financial test the U.S. markets have faced all year. We've got pivotal economic data that's finally coming out, some major decisions hanging in the balance, and market sentiment is just stretched between, tech euphoria and a pretty tense geopolitical reality. So today we're diving deep into a stack of sources. We've got Bloomberg, CNBC, Reuters, Yahoo Finance, and together they really paint a picture of an economy that's being defined by these huge data debates, enormous capital spending, and some very aggressive policy. Our mission for you, the learner, is to quickly get a handle on the core tensions. We'll unpack this battle in the U.S. bond market, what the data says versus what traders are betting. Then we'll get into the new skepticism around the magnificent but hugely expensive AI trade. And finally, we're going to see how industrial policy and even commodity shortages are shaping the global landscape right now.
It's a really information-dense Monday. But you're right, the focus has to start here at home, specifically with U.S. interest rates. The entire market it's holding its breath for data we've been waiting weeks for.
Okay, let's get right into that. This core conflict in U.S. rates, I was reading Michael McKenzie and Yeji in Bloomberg, and they argue the debate over Fed cuts for 2026 is, and I'm quoting here, about to heat up. So the central question is the Fed done easing after those 3 straight cuts, or do they have much more left in the tank?
And that debate is heating up for one reason. The data void is finally closing. We're finally getting those delayed monthly employment and inflation reports this week.
The ones held up by the government shutdown.
Exactly. Normally, the market digests these things piece by piece, but because they're all clustered together, they carry this huge significance, especially that jobs number.
And the jobs report on Tuesday, some are calling it the single most important data point for next year. Why so much weight on one report?
Because it's going to dictate the pace of everything else. George Catrombone of DWS Americas sees it as exactly that, the single most important data point for next year. The market consensus is pretty modest.
What are they forecasting?
Strategists are looking for an increase of only about 50,000 non-farm jobs. But the risk here is, well, it's asymmetrical.
Meaning, if it's a miss, it's a big miss.
Precisely. Strategists are warning that a fall in payrolls, not just a weak number, but an actual contraction, could radically speed up the market's timeline. It could pull the pricing for that first full rate cut all the way from June up to April.
Wow, 2 full months.
2 months of anticipated stimulus, yeah.
Yeah.
All potentially triggered by that one report on Tuesday.
And that really sets up this expectation gap we're seeing. The last Fed cut put the rate range at, 3.5 to 3.75%. But the swaps market, traders are betting on 2 more cuts next year. That's 1 more than the Fed itself has indicated. So they're basically saying the Fed is behind the curve.
And that market expectation just slams headfirst into this debate over the neutral rate. This is, a really crucial concept for you, the listener, to grasp. The neutral rate, or R star, is essentially the Goldilocks rate.
Right, not too hot, not too cold. It doesn't stimulate the economy, but it doesn't restrict it either.
Exactly, just keeps things running smoothly. And analysts, kind of echoing Chair Powell, they argue that 3.5% is that neutral rate.
So if we're already there.
If we're already there, like Kevin Flanagan of Wisdom Tree suggests, then there's very limited room for more cuts before you risk, overheating things. But the swaps market tells a totally different story. Traders see the cycle ending lower, around 3.2%.
So the market thinks the economy needs more help than the Fed is letting on.
It thinks there's some latent weakness that this delayed data is about to reveal.
Okay, now let's add the political layer. We're drawing from Bloomberg and Yahoo Finance here, and this just adds a huge complication. Chair Powell's term is up in May, and President Trump is very publicly pressing for much lower rates. That has to be adding a political tailwind to what the market already wants.
Oh, absolutely. When Kevin Hassett, who's a frontrunner for the job, addressed this, he did the expected, high wire act. He said he'd consult with the president, but that decisions would be independent and data-driven.
Of course. But the market isn't really focused on the official statements, is it?
No, it's focused on the implication. And Janet Rilling of Allspring Global Investments noted that the mere possibility of a dovish tilt from a new chair is adding this significant tailwind of anticipated stimulus for 2026.
So the market is pricing in the political pressure.
It knows that political pressure often lines up with its own desire for lower borrowing costs. That's why treasuries are on track for their best year since 2020. Investors are betting on cheaper money, supported by politics.
It's fascinating how those same capital pressures, this need for easy money, are at the same time creating this kind of existential risk for the biggest names in the equity market. I'm talking about the AI trade.
Yeah, we saw that tension play out in a really dramatic way last week with this whole AI bubble narrative.
Right.
U.S. indexes fell sharply on Friday, and it was led by tech, NVIDIA, AMD, Oracle, and most notably Broadcom, which fell over 11%.
And that's the paradox, right? This is from our CNBC sources. The sell-off was so jarring because Broadcom's earnings and their guidance for the current quarter, they actually breezed past expectations.
I mean, by all accounts, the company is over-delivering.
So if performance is great, why are investors dumping the stock?
Bernstein analyst Stacy Rasgon summed it up perfectly. He said, and I'm paraphrasing, "Frankly, we aren't sure what else one could desire." The AI story isn't just delivering, it's accelerating. And that really highlights this core shift. The fear isn't about revenue today.
It's about the cost of tomorrow.
It's the massive cost required to realize that future.
That's the crucial insight. This capital burn is laid out in a Bloomberg piece. Wall Street sees AI bubble coming. And it points out that building this foundational AI infrastructure, the data centers, the chips, the power grid, it's straining the old financial models of these tech companies.
I mean, just look at the scale of it. OpenAI alone is planning to spend an astronomical $1.4 trillion in the coming years.
That's bigger than the GDP of a lot of countries.
It really is. They expect to burn through $115 billion in cash through 2029 before they even hope to generate positive cash flow in 2030. This is not a startup. This is nation-state level spending.
And the big guys, Alphabet, Microsoft, Meta, are all in this CapEx race too. Their spending is projected to top $400 billion in the next 12 months alone.
And that all flows into a concept we need to define for the listener: depreciation expense.
Okay, what is that?
Depreciation is the quiet killer on an income statement. It's an accounting measure for how quickly your assets, in this case these giant new data centers, are wearing out. It's a non-cash expense, but it still cuts directly into your reported earnings.
And it's getting bigger.
It's soaring. For those three giants, it went from about $10 billion to nearly $22 billion in 2025, and it's expected to hit $30 billion by the end of next year.
So, as an investor, why do I care about a non-cash expense?
You care because it signals a massive necessary drain on future free cash flow. That's the money companies use for buybacks and dividends. Historically, big tech was this asset-light, high-margin dream. Analysts are warning this shift to a heavy CapEx business is forcing them to become more like, a utility.
Which means their valuations have to change.
You could force a multiples contraction. Their old valuations are based on that asset-light model. The AI pivot completely changes the math.
But despite all these AI jitters, Wall Street is still pretty bullish on 2026 overall. Yahoo Finance notes that strategists like Oppenheimer's John Stoltzfus, he has an 8,100 S&P target, and Ed Yardeni, they're still pointing to stimulus and GDP revisions as major tailwinds.
And we should, push back on the full bubble fear. Valuations are high, yes, but Bloomberg data shows the NASDAQ 100 PE ratio is at about 26 times projected profits.
Which is nowhere near the dot-com peak.
Not even close. That was over 80 times. So it's a key distinction to make.
So what's the advice then for the learner in equities? Steer clear of the AI names.
Not necessarily avoid them, but definitely look for diversification. The Magnificent Seven are still forecast to post 18% earnings growth in 2026, but that is their slowest growth in 4 years.
So the growth is decelerating.
Right. So Goldman Sachs strategists are advising to look at sectors that will benefit from this broader recovery. Think transportation, home builders, healthcare, and energy. The rally is expected to broaden out.
That transition from speculative tech to more cyclical value, that brings us perfectly to the global economy. Let's shift focus to these two huge forces, China's consumption problems and the, stratospheric rise of a key industrial metal.
The data out of China for November, this is from CNBC, was deeply disappointing. It really underscores a deepening crisis for the consumer there. Retail sales rose just 1.3% year-on-year.
Which was a sharp miss of the 2.8% forecast, so consumers just aren't spending.
They're not, and it's not a blip. Industrial production also missed, marking the weakest growth since August of 2024. But the most alarming number for long-term confidence is fixed asset investment.
The money going into buildings, infrastructure.
Exactly, and it contracted 2.6% over the January to November period. That is the sharpest slump since the 2020 pandemic, and it's almost all being driven by the collapse in real estate investment, which dropped nearly 16%.
Now, we know policymakers have pledged support. They're issuing these ultra-long-term special government bonds, but the consumer is still on the sidelines.
Right. And analyst Xavier Wong really highlights the problem. It is hard to generate a meaningful pickup in consumption without clear improvement in job prospects and wage growth.
Right.
Even their big Singles' Day sales event was a dud. People are saving, not spending.
And in just stark contrast to that slowdown, you have the commodities market, specifically copper, hitting multiple record highs, up 36% this year. The LME spot price hit, what, $11,816 a ton?
It's an incredible story. And Citi analysts are so bullish they're forecasting prices of $13,000 to $15,000 a ton in 2026.
What's driving it?
On the demand side, you have two massive structural forces. First, the energy transition, electrification, grid expansion. That all requires tons of copper. Second, AI. Data centers need huge amounts for wiring and, crucially, for cooling.
And then you layer the supply constraints on top of that.
You do. Mine disruptions have forced major miners like Glencore and Rio Tinto to cut their 2026 output forecasts. They see peak market tightness coming in the first half of 26. But the most recent surge, this is according to CNBC, it's pure geopolitical distortion.
Driven by U.S. tariff concerns, how does the idea of a future tariff affect the physical price today?
It creates an arbitrage opportunity. Traders are betting that future tariffs will make copper imported into the U.S. way more expensive than the global LME price.
So what do?
They buy it now and ship it to the U.S.
They're rushing to buy physical copper globally and hoard it in the U.S. to take advantage of that future price spike. And this physical hoarding has just dramatically tightened LME supplies. Inventories are down nearly 40% since the start of the year.
So the price isn't just about fundamentals anymore.
It's about policy and risk management.
That tariff distortion is the perfect segue to our final theme. This new era of policy-driven markets. 2025 was a blockbuster year for M&A. $4.5 trillion in global deals. According to Bloomberg, that's the second highest tally ever. Yet, dealmakers are clearly feeling emboldened. They're looking at that rate-cutting cycle we just discussed, which makes debt cheaper, and they perceive what they're calling friendlier regulators.
Which has led to these mega deals, like Netflix buying Warner Bros., Discovery for $83 billion.
Or the Union Pacific-Norfolk Southern Rail merger for $85 billion. It shows that CEOs are willing to, dream big again.
And this perception of friendly regulation comes with a new national industrial strategy. Bloomberg highlighted what they call the Trump effect on deals, where the administration is actively blurring the lines between state interest and corporate action in these mission-critical sectors.
That blurring is the key. The government isn't just a referee anymore. They're investing. They're dictating terms. We saw them take stakes in Intel for domestic chip manufacturing and in the rare earth producer MP Materials.
And they secured that golden share in the U.S. steel takeover. What does a golden share actually let them do?
It's a strategic minority stake. It means that as a condition of approving the deal, the U.S. government gets veto power over future decisions that affect national security.
Yeah.
Things like moving key assets overseas or selling to certain foreign buyers. It's a tool for directing capital.
And the push to revive U.S. shipbuilding, which CNBC detailed, seems like the clearest example of this new industrial policy in action. The goal is to bring back production of LNG tankers, icebreakers, Navy ships.
It's an aggressive goal.
Yeah.
And the challenge just shows how far the U.S. has fallen behind. We account for a tiny 0.2% of new ship orders globally.
While China has.
China has 75% of the market. The U.S. has 8 active major shipyards. China has over 300. You don't close that kind of gap overnight.
So we have to rely on foreign partners to rebuild our own capacity.
Absolutely. The reliance on allies is a huge piece of the strategy. South Korea's Hanwha Group is investing $5 billion in the Hanwha Philly shipyard. The aim is to expand capacity from, 1 or 1.5 ships a year all the way up to 20.
It's a massive jump. And we're seeing it in defense, too, with the Arctic push.
Yes. The U.S. is turning to Finland, the world leader in icebreaker design. There's a $6.1 billion agreement to get 11 new ships. 4 will be built in Finland, 7 here in the U.S. It's all about leveraging allied expertise to rebuild American industrial strength. So if you put all these sources together, you see this really defining conflict emerging for 2026. On one side, you have these massive capital flows directed by the decentralized speculative drive of AI. and straining balance sheets. It's raising depreciation costs. It's forcing big tech to completely rethink its business model. And then on the other side, you have equally massive capital flows being directed by targeted, aggressive government policy. It's aimed squarely at national security and infrastructure, shipbuilding, semiconductors, even distorting the copper market with tariffs. The tension between that tech euphoria and this new centralized industrial stimulus, that is going to be
Yeah.
the defining economic conflict you need to track.
That is the ultimate synthesis. So we've covered the Fed's imminent data test and the political pressures in the bond market, the huge capital demands creating skepticism around AI, the unexpected strength in copper, and the geopolitical implications of this U.S. industrial renaissance. Thank you for joining us for this deep dive. We'll see you all tomorrow morning with new headlines from major financial magazines.